Hi, this is Rachel Wright here with Beard Bros Media and Beard Bros Farms. Today we're here talking about debt and equity capital on our podcast, which is CFO Podcast, Financing Your Future. And today we're here with Eric Kaufman of Fund Canna, Kevin Haller of PP & Co. We're going to have some awesome dialogue here, guys. When we were chatting yesterday, the conversation could have gone on and on and on. And, so I just want to give us a quick intro and say all of us have been in the industry for a long time. And that's what you're going to get from us is just a wealth of knowledge, resilience, and that's what you want actually in your advisors and the folks that you surround yourself with. So with that, I'm actually going to kick it off with Eric Kaufman of Fund Canna with his introduction.
Thanks, Rachel. Thanks for having us. Looking forward to a great conversation. As you mentioned, been in cannabis for quite some time, since 2019, which in a nascent industry is somewhat of an eternity. Also, because of that, seen the ups and the downs and the ups and the downs, and I'm sure we'll have many more. I'm currently the COO of Fund Canna. Fund Canna is the largest short-term debt provider to the cannabis industry. So we've underwritten, call it 3,200 clients, funded more than half of those, approved over $300 million. So pretty well entrenched and fund across the country. So looking forward to having a great conversation.
Thanks so much, Eric. Okay, and with that, we'll go to Kevin Haller. Go ahead and kick us off there. Yeah.
Thank you so much, Rachel. It's an honor to be here. My name is Kevin Haller. I'm a CPA with Petronovich Pugh & Company. I've been serving the cannabis industry since 2015 on a professional level. I always say in the cannabis industry, it's kind of like dog years. 1 year in cannabis is like 7 years. It is a very tough but wonderful industry to serve. I am on the assurance side. So although CPA, people normally think taxes. So what we do is we validate financial information. Assurance is basically giving a declaration in a positive light, or think of it as a promise. So what I do is I validate financial information so that owners, potential buyers, lenders have more confidence in the numbers.
Amazing. And I've worked with both these lovely fellows here, and they've provided amazing work for my clients. And you can expect that from them. And with that, I'm Rachel Wright from 420 CPA and Newly Verdant Strategies, an extension of 420 CPA. I've been in the industry for 10 years. We service clients, tax, accounting, basics, but also consulting for some of our clients as well. And so as a result, we need to surround ourselves with it in here. So with that, I want to kind of lay the financial landscape here. So we don't always want to assume that everybody knows the terminology is key. So let's kind of start with that. Eric, do you want to talk about the different types of capital that there are out there and the ups and downsides of each one? Just let's lay the financial landscape here.
Yeah, I think the two most obvious, or the two most commonly talked about, are equity and debt. Equity, you're raising money, you're giving up a piece of your company in exchange for that money. The benefit is you don't have to pay it back. The downside is you now have a business partner. And depending on how you structure that, that could be a good or a bad thing. Debt is you're just borrowing money. So the upside with that is that you don't have a business partner. And as soon as you pay it off, that debt provider is removed from your capital stack. The downside is that you do have to pay it back. And there's a place for both. Both are great, and both have a place at a moment in time, depending on what you need and what you're using it for. But at their most basic, that's what they are. One is you're selling a piece of your company in exchange for the money, and the other, you're just borrowing. And I think, particularly early on in cannabis, the fad or the trend was everybody wanted equity. They're raising capital. They wanted equity. Valuations were absurdly high. So you were getting money based on a very frothy marketplace. And debt, for whatever reason, has a bad connotation, maybe because it's a 4-letter word. But debt can be a great thing. And every major multinational public company, everybody leverages debt. And as long as you don't over leverage yourself, it's a fantastic tool.
Yeah. And so on that note, Eric, how about discussing the term leverage and the concept leverage? What does that mean and how can that help your business?
I think leverage can mean many different things. Financially, it's the way I look at it for this industry. It's the ability to leverage capital or take advantage of capital to facilitate growth, right? And there are only so many dollars to go around. So how do you spread those dollars efficiently to enable yourself to grow? I think we've all probably seen companies that are doing well, but just can't get off the hamster wheel to get ahead. And they're actually getting orders and their business is growing, but they don't have the capital to facilitate the growth. They can't buy the raw materials to fulfill the order. And then they start robbing Peter to pay Paul, which has led to the really challenging situation the industry is in now with the aging AR issues. So I think when I look at leverage, it's smartly and efficiently leveraging capital to facilitate the growth of your business and not getting over leveraged where that debt then has a stranglehold on you and puts an end to your business, right? It could go both ways, but it comes down to running an efficient business. And, when we go back to looking at the financials and where Kevin provides the assurances, it's, do you run a tight ship? And if you don't, you will get over leveraged. No different than in your personal life, where if you run up your credit card bill, you may have a maximum amount you could spend on your credit card bill of whatever it is. And if you run it up and can't pay that off, you're now over levered. But if you pay it off every month and you're responsible with how you use debt, then that could be a great tool.
Yeah.
Awesome.
I always think you need to be strategic with leveraging. So it's not being reactionary. You don't want to react to not managing your money. And then you're, like you said, robbing Peter to pay Paul, paying the past. Being strategic is you have a plan, you understand the numbers and you're making a decision, but it might be for growth. Like you said, do we need to buy some machinery and equipment that'll help us get to the next level? Do we need a new facility? And then you leverage debt to help you achieve those, but you have to make sure you have a good plan in place so that you don't squander the money and then you're in a tight spot.
Well, we've seen historically, because access to capital, whether it's equity or debt, the ease of access has ebbed and flowed. What people have done is they've not paid their federal taxes. And because that penalty is low, they've effectively used that as a line of credit, which I don't recommend doing, because at the end of the day, you still need to true up and you're only getting further and further behind. And I think that becomes a good example of maybe getting over levered to a large degree. Yeah. And that's a reactionary approach.
And then you're not compliant, right? I always say it's like right now you're in the compliance game. And it's being compliant so that you can stay afloat until rescheduling and changes happen in the industry where it'll really take off.
Yeah, definitely. Yeah, I've seen people push off paying their taxes as well, and even filing their taxes. And they think of that as a way that the IRS is funding their operations. And, I've got to say, you have to make a strategic decision to do that. In some cases, it might work if you're unable to get lines of credit and you have a timeline on that. And it's, maybe you're in a growth stage and you want to use that capital for instant growth. But it is a slippery slope because you can actually get into bad situation if your plan doesn't work out. So you have to make sure you have a very solid plan if you're going to go that way.
Yeah.
So.
And just understanding your taxes. Oftentimes I'd see businesses where they're not accruing them. They don't understand them. And then when they finally get around to filing a return, it's like they gasp at how much it is. And then, you're just always behind, and that's never a good place for a business to be in. So that's why oftentimes I'll see businesses, they almost look at the numbers, help them just file a tax return. And it's like, the numbers are so much more. The numbers should drive every decision the business makes. And if you're not committed to the numbers, you're almost not committed to the business because you're totally flying blind. And it's a matter of time. And in this industry, that's dangerous, right? We've seen it time and time again over the last 9 years of just heads being lopped off from poorly managing capital resources.
Well, Kevin,
Focused too much on growth.
Yeah, go ahead, Eric.
We talked a little bit about it yesterday, Kevin, when we were talking, especially in the early days as it related to taxes.
Yeah.
Everybody's setting up multiple entities, a management company to represent this, a different entity for the plant touching, a different entity for real estate. To some degree, that can make sense. To another degree, if you're doing it to avoid taxes, eventually it's going to come home to roost, and you're not going to avoid it. It's going to catch up. Never mind the expense of the oversight of managing, 15 different entities when you really need 2, and the complexity that comes with that. But the point I think we're all making it eventually catches up.
Yeah. I would see it time and time again where businesses, they want me to architect how they get around paying taxes, and they will come up with big schemes on multiple entities. And it's like the administrative burden, the legal costs, staying on top of it. And I always just say it's keep it simple, right? You know that the taxes are just the cost of doing business. And the more you try to evade that through structures, you're just paying in a different bucket, but you're not really mitigating that tax liability. You're actually compounding it.
Yeah, I love doing this. Actually, I do tax all day long. So I guess what I would say is it depends, right? So some of our clients come in with 30 companies. Half of them are shells. Some of them were intended to apply for licenses. They haven't, dissolved those entities, filed final tax returns or anything like that. So what I do first is I look at their org structure when they come in. Let's first get rid of any companies you don't need. Okay. And then let's kind of hone it down into the companies that are actually true, legit, bona fide, different types of lines of businesses. So if you have a real estate holdco, that actually makes sense because your cannabis company can pay your real estate holdco rent if it makes sense. And then you can have a tax arbitrage there where you have potentially like your operating co has an LLC taxed as a C corp, which is actually paying a partnership for rent. So if you look at like the whole landscape, in some ways that can actually make sense, right? Because ultimately,
that goes to what both of you were saying, though. It's right. It's be proactive and be strategic.
Exactly.
And you can be efficient with managing taxes in your business, but you can't avoid paying taxes.
No. But you can do it wisely, and you can do it using companies. But you can't just invent companies out of nowhere.
Yeah, and that's real estate should be in an LLC rather than a corporation. So I always say it's like you want to manage risk. So it's being strategic on what entities are necessary, running it as lean as possible, but separating things often makes sense. Like, right, most businesses have multiple entities depending on what you do. Right. I saw just egregious entities being created in an attempt to offload and navigate 280E, and it was kind of like you're not getting around it. For creating an entity to move things over here to lease it back. If it's all the same ownership, eventually that mist or smoke you're creating will get uncovered, and you're going to be in a worse spot financially because the administrative burden of all those entities is incredibly high. And then you didn't navigate the taxes the way you did, but smartly putting real estate in an LLC and having a lease agreement and maybe separating certain operating functions, absolutely smart.
Right. Yeah, just don't invent companies out of nowhere. I have people come to me and say, how do I circumvent 280E? And it's like, no, that's not the question. Let's talk about the other lines of business that you're already in, like bona fide. We're not inventing lines of business for you to be in to circumvent 280E. And the only kind of arbitrage there is between the entities, really, because you can't, if you're going to expense in one place, you got to pick up income in another place. And, is it in a entity type that's a little bit more beneficial? That's the question, right? Yeah. And so just like you said, Eric, it has to be done in a wise way. And that's, the old days, inventing a bunch of companies,
That's right. And I think what we're kind of getting at here is what you opened with is that we've all been around the industry a long time. So you want experienced advisors, and you want experienced cannabis advisors specifically, because this is unlike anything else out there. And so you want not to toot both of your horns, but you want tax professionals that have been around, seeing what has worked, what has not worked, all the ups and the downs that can help you make good risk reward decisions because you've been through it several times. And, if I'm an operator, that's what I would be looking for, is a seasoned executive that knows what they're doing, that's seen it all.
Well, yeah. Right. And I always find it's my job to redirect them when they're like, how do I navigate taxes? It's like, the question is, how do you optimize your top line? How do you manage your costs? How do you, produce the highest quality at the best cost and have the greatest yields, right? Those are the things that you focus on. That's how you successfully run your business, not how do I create a business to move this to avoid that tax? And it's like, you're wasting dollars that could be put towards really dominating the space. Because, again, it's like the consumer wants a high quality at the best price. So your job is to replicate that quality time and time again and manage your costs as efficiently as possible. So it costs you less and less to produce that top quality.
Well, that,
yeah, go ahead.
Well, go ahead, Rachel.
No, I was going to say, I think in a mature industry, and that's where we are right now, where it's not raining money everywhere. This is where it separates the men from the boys. That's what I always say. The women, the women from the girls, or whatever you want to say. This is where the rubber meets the road. And so, just to what Kevin was saying, we have to actually manage our businesses, manage our finances. Tax is obviously part of that ecosystem, as well as debt. Wise debt capital or equity is all part of that whole ecosystem. It's like we all have to kind of grow up and mature along with the industry. But go ahead, Eric. I was gonna, if you want to go.
Well, I think one thing I've seen is in the evolution over the last several years is a decrease in the hubris, right? Which is a good thing. Early on, everybody was an expert in everything, which is impossible. I can't tell you how to grow. I can't tell you which lights to buy, nor do you want me to. So rely on the experienced professionals on the tax side, you guys, to be able to provide you the advice and guidance. Don't take it at face value. Feel free to question and collaborate with your advisors, but you've hired them for a reason, and then follow that advice and guidance, because it's impossible to know everything. And I don't do my own personal taxes because that's not my world. I have somebody else do that.
Well, and with that, I just want to say, so Kevin, I work with Kevin quite often. He works on, I'll bring him in for various reasons, because I'm a tax person more than I am a internal controls person, which is so important. Also, when clients need assurance on their financial statements, that is not something that I do. It's almost like when you go to an attorney, when I refer to attorneys, or I know attorneys, I say, hey, do you do transactions? Do you do M&A? Do you do this? Do you do, what exactly do you do? So Kevin, when I'm working with a client, a tax client, or just general consulting client, we had a specific example where there was a CFO of a company and there was some questionable practices. The CFO was recording, had control and custody of the cash, was also making the business decisions. There was lack of transparency. And I said, I got to bring Kevin in here to look at these internal controls. So he is, I'd like to give you a moment, Kevin, to talk about exactly that process. Yeah.
Sure. So, overall internal controls, the main thing is you have three main pillars of internal control. You have operations, reporting, and compliance. So operations, if you're a producer producing, that's having SOPs and basically doing the best you can to streamline it, right? We don't want to wing it and just say it's a feeling, right? And in that instance before, so many times this is an industry based on like trust, and you have someone come in and it's like, oh, we trust them. But it's like companies need to build processes that people follow, because it's like, I trust you, but I also need to make sure I have checks and balances, right? Because there's been too many things that have gone wrong. And so you have to be top of your game in operations. You also have to be top of your game in reporting, right? You have financial information that should drive decisions. It should lead towards strategic capital requirements or debt requirements so that you can grow your business to the next level, not reacting like factoring AR or selling things off to stay afloat or getting money just so that you can stay alive, right? So, and then you have compliance, which in cannabis, you have compliance coming from every which way, from the Department of Labor, from state, local, federal oversight bodies. So any one of those three pillars, if neglected, can cause your whole business to collapse. And so you have to put effort into each of those, and you have to document policies and procedures to properly navigate that. And in that one example, the CFO had too much control and power. When you get into the nitty gritty, you want to make sure you're separating custody of an asset, the ability to record a transaction, and the ability to authorize a transaction. Any one person who has the ability to control those can commit and conceal fraud. So a business then needs to segregate duties and functions so that they have checks and balances in place. And so that's kind of what we help with as an auditor. We have to go in and assess the risks that could go wrong, that could lead towards a material misstatement in the financials. And we have to design and do audit procedures to navigate that. And so we really have to get in there and understand the company's internal controls, walk through those controls, understand whether there's any vulnerabilities that would require further testing. So companies need to be proactive about setting that up. And what happened in cannabis in particular is everyone got the money, and the money was used for growth and to dominate the space, right? You had a bunch of white collar coming in that just wanted to own the space. And really what they should have done is use those dollars to dial in a business's foundation for success. And then you start growing. But the growth was put well before anything else. And most things were focused on operations, or maybe even compliance, or I should say components of compliance. And really reporting and other things got incredibly neglected along the way. That's why you saw people lending and floating product to people they never should have. And then AR got too big. And then you saw a lot of giants go belly up because everyone was using each other as leverage to run their business. And because they weren't running it properly, they all got behind and they weren't able to pay people.
Well, Ken, I think you touched on a couple great things there. One, in the early days, it's not dissimilar to the early days of the internet boom, where nobody focused on profit. They just focused on growth, and eventually it would come. Well, eventually, if you just keep throwing good money after bad, it doesn't come, and you get out over your skis, and then it's a little too late. So we've seen that consolidation. I think we saw that, in the trend, particularly in California, where everybody wanted to be vertically integrated because they wanted to own the entire supply chain. Well, in what other industry in the world do you try to own every part of the supply chain? Each one, cultivation, manufacturing, distribution, retail, those are all very distinct businesses and take a different set of experience and expertise to be able to run. So to try to roll that up all in-house and think you could do all of those things when we're all just learning the industry as a whole because it's just evolving is kind of asinine when you take the look at it in the rearview mirror. It's kind of crazy. And then trust. I think, it's remarkable what everybody in the industry has been able to achieve when you think about all the headwind that we faced. And so much of it was built on trust. But eventually, if the controls, as you were talking about, aren't in place, that does come back to bite you. And that is how we got the aging AR, right? Originally, you would only buy from people you know. Then you would extend them terms because they had trouble paying, so, on a handshake. That's great when everybody eventually pays on time. But as that starts to extend and people aren't paying, not because they're trying not to pay you, but they actually don't have the money to pay you, correct, that becomes a problem throughout the entire supply chain. And then you get to the point where the states who don't really understand the problems, like in New York, if you don't, I think the rule is you don't pay within 15 or 30 days, you go on a no-no list. Well, all right, great in theory, but the entire state will be on that list because if they don't have the money to make the payment, they can't make the payment whether they want to or not. So how do we solve the underlying issue? Instead of creating a rule that you throw on top, how do you solve the underlying issue? And that comes back to running a disciplined business and having controls in place. We talked a little bit about it yesterday. The trend that we're seeing is everybody's waiting for it to be cannabis to be rescheduled, and then 280E goes away, and then they're all flush with cash. Great. There'll be a windfall. But if you run a bad business today, you're going to run a bad business tomorrow, and you're going to blow through that margin and then be back in the same place. So it's going back to having discipline, having the controls in place, and having a team of advisors that can help support you and help you make good decisions and using that data, right? If you're not in tune with the finances and the data, then you're not in tune with your business. So it's using that information to make solid business decisions.
Eric, do you want to talk about when do you, I know we talked a little bit about debt, capital, and accepting investment. Can you talk about that a little bit, and also dispelling the myth on debt.
Yeah, look, I think when you start a business, you're not getting any debt. Nobody's going to loan you money on an idea or business plan, right? You're going to need equity capital. Usually that comes in the form of friends and family, right? And in exchange for giving you the money, they take a piece of your business. As you start to grow that business and you're a going concern, then you could try to leverage debt. For example, at Funcana, we don't want your real estate. We don't want your product. We're underwriting you based on gross annual sales. So we need at least 6 months of revenue coming through, and then we can extrapolate that to an annual run rate. But we underwrite you on sales. So once you have a business, you can go out and try to leverage debt. And debt, as we talked about earlier, can help you facilitate growth. It can help you make acquisitions of land, finance your inventory, help solve aging AR, make payroll, whatever you want to do with it. The two things that we see right now are the biggest challenges in the industry are aging AR and inventory financing. So you can leverage it to do that, but you have to be a going concern to be able to take advantage of debt. Again, you can't get that at the outset.
What does going concern mean? Just I'm just saying for our audience, let's define what that means. Because
great question.
Go for it.
You're in business. You're running a business, right? You're no longer an idea. You're not doing a build out of the dispensary. Not that there's anything wrong with that. Everybody has to do that to get to be a going concern. But the going concern means you're now in business. You're making sales, or you're growing product, or you're distributing product. You're running the business. It's up and running, and you're generating revenue.
It means a low risk of your business like shutting its doors within a year, so it's not a troubled business.
Exactly.
So Kevin, when you do audited financials, you have to make a management representation, and you know more about this than me, but because you're an auditor, tell us what going concern means.
Well, we have to assess that, right? As part of the audit, we assess the risk. We look at the numbers. If we see any issues where it's like it looks like it's a troubled business, right? Where it's like you're not paying your payables on time, you're not collecting your receivables. There's all these issues. We have to go through and assess whether the company will be around. And actually in our report, if there's any concerns the company won't be around within a year, we have to specifically call that out. And so that would be a part of the audit report that, this business, they're not operating as a going concern. And so we have to assess that a lot. And we do that in this space in general, because it's like, you're also at risk of, if the federal government changes its tune, that's going to change your business. I mean, if all of a sudden, and everyone's like, oh, rescheduling, yay. It's like, that really depends on what that entails, because I don't want to go to CVS to get my weed. And I know a lot of people don't. You don't want it to be rescheduled as this medical thing that then basically changes the game quite a bit for a lot of people. So it's kind of like, well, what does it really entail? How are they doing it? Are they just removing it? Are they moving it to a pharmaceutical? And those bring risks. And so as part of the audit, we're always assessing that to make sure. And cannabis, just by nature, given how the industry kind of has operated, we're always paying a lot of attention to that.
Well, Kevin, you make a great point. I think people have to run their business as if this is the current state in the future state, because we don't know what's going to happen with rescheduling or when. So you don't run your business anticipating rescheduling, because you don't know what that will look like or when it will happen. So if you're running your business hoping that's going to happen in March, you may be sorely disappointed. So you have to run your business as if the current state is the future state. And then if and when those things happen, you'll figure out how to pivot. But if you're just running it today, hoping that it's going to hit, at some mythical future date and time, then you're going to have a hard time.
Well, that's why it's like, I believe everyone should be, it's almost like you're holding down the fort right now, right? It's like, you should be rationing. You shouldn't just be spending nilly-willy. Like, I mean, it was funny how early stages, I'm talking with people that are in the licensing process, counting their billions on the beach before they've even gotten their hands around anything. And it's kind of like, you're weathering the storm right now, right? It's kind of like, you have to be very cautious and at least strategic and wise in terms of how you're going to grow. And like your point before, again, what part of the supply chain are you going to live in? How are you going to be the best at that? If you're retail, you want to burn and turn product. You got to really understand what's selling in your area and what products are good, and making sure you're investing your dollars in that, and you can keep up with the demands of your consumers. If you're a producer, it's incredibly different. You want to optimize your yield and quality, and it's very challenging when you're dealing with biomass, right? So it's kind of like, how do you consistently get results? I would talk with some cultivators where they have like 30 strains in a room, and you're like, what are you doing? Not all of those need to be treated the same to optimize your yield, and you're trying to be everything to everyone. Maybe if you brought that down and had more of a narrow focus, you will kick out fabulous quality, which builds your brand. It gives you demand. You're known for what you produce, instead of trying to be like, we do everything. And that was the biggest problem, because it's like the people who wanted that had the money, the white collar, but they had no clue of the industry they were getting into. The green collar knew and was connected to the consumer, but they didn't have the capital or the business savvy. And both sides kept butting their heads together, trying to block the other. And it's kind of like, there's plenty to go around. And if you two got together and worked together, we'd probably be in a much better spot today. But then, regulators got incredibly greedy, and that made it challenging. Where in California, it's like they tried to tax you every step of the way. And it's like, you guys are forgetting there's a huge illicit market here, and the consumers are all connected with them. If you're making it so a company cannot price its product to be consistent with historical expectations by consumers, they will continue to support the illicit market, because again, they have so much discretionary income. They want the best bang for their buck. And if I can get 4 times the product over here than in these stores, where am I going to go? Of course, I'm going to go over there. So it was just a perfect storm that everyone had to deal with. And that's why it was like being strategic and smart and understanding all those costs that are coming, understanding your consumer, pricing things properly, optimizing your operations. Those were all incredibly neglected in this space.
Kevin, one thing that you started talking about is the butting heads of call it the incumbents versus the white collar that were coming in. And I think there was a mutual lack of respect for each side's expertise, right? And let's specifically in California, right? You had a lot of incumbents that had emanated out of the illicit market and knew how to run a great cannabis business. That's different than running a great cannabis legal licensed operating business.
It's scaled, right? Most of them had small ops. Now you're talking about big facilities.
Right. And then you had a lot of people coming from outside the industry, some of whom were entrepreneurs, but many of whom weren't. And this is an entrepreneurial industry by its nature. And if you've never started anything, run anything, you've only worked at a big company, if you undermined or underestimated the intelligence and the integrity and the work ethic of those in the industry and the nuances of cannabis, then you were going to fail. And we saw that time and time again, particularly with CPG on the brand side, where we've got a unique industry. You can't move product across state lines. So you've got a brand that's a big deal in one state, and you go to next door and they've never even heard of it. So how do you reinvent? Do you license it? Do you start it up? And so we tell anybody that I talk to that's just getting into the industry, I say, bring your experience from another industry and then throw 80% of it out and take the remaining 20%, and you'll be able to apply it to some degree here. But come in humble and understand that this is unlike anything, because we're writing the rules as we go, and they change daily. And nothing that doesn't happen at Procter & Gamble, right? Just doesn't. So this is something unlike you've ever experienced. So you have to come in with that humility. And you've got great experience, but much of it is not going to be applicable.
Okay, guys. So I want to go to, because a lot of folks have reached out to me for this podcast to talk about the mechanics of when somebody comes to you, Eric, what are you going to ask them for?
So we have, our process is very, I think, streamlined and straightforward. We have a product called Ready Paid, where you could do it online, and in less than 5 minutes, you can get auto approved for $10,000 or $25,000. If you want to go through a slightly longer process, we'll fund anywhere from $5,000 to $5 million. And when I say slightly longer, anything under $1 million, we can usually turn it around in 24 hours. Anything over that, it's 3 to 5 business days. So very fast. We look for bank statements, and we use instant bank verification, which means Plaid. Many of us are experienced with that. When you go to Venmo or Firm or Klarna and you link your bank account, you're using an instant bank verification tool. Most people haven't heard IBV if they're not like knee deep in a dork like I am in this side of the business, right? But when you see Plaid or Affirm, Klarna, Venmo, Zelle, right, it's linking directly to your bank account. It's totally safe and secure. We do online ID verification through a platform called Persona. So we get your bank statements, we link to your bank account. We ask for tax returns, a P&L, and what we're really looking at is inflow and outflow of funds, because what we're trying to lend to you for is to facilitate growth, not a lender of last resort. So we want to make sure that our weekly repayment isn't a burden, that you can absorb that payment as you're growing and that you're using the money to grow. And I think one thing we're most proud of is that after 10 months of being with us across our entire portfolio of thousands of clients, they've shown on average 54% growth. And what that means to me is that not just that we're doing a great job, but that the industry is actually healthy, right? They just need capital to unlock the growth to help their businesses. And that we're able to do that feels really good.
Awesome. And then, Kevin, do you want to chat about actually the different types of levels of financials? Because Eric just mentioned a P&L there. Can you just, we're going back to basics, kindergarten. Let's just go, proficiency in financial terms here. So if you could take us back, that would be great.
For sure. And it's important to know that, overall in this country, the main universal language of financials, right, is GAAP, generally accepted accounting principles. There are different types where you could be an income tax basis or cash basis, but most investors want to see GAAP. And then when it comes to the different financials that are in a set of financials, would be a balance sheet. Think of a balance sheet as a photograph. It's a snapshot in time. So it would more so show your assets, liabilities, and your equity. So how much do you have in the bank? And again, if it's GAAP, it's not necessarily what do you have in the bank, because you have, deposits in transit, you might have outstanding checks. You have receivables, right? Customers owe you, but also under GAAP, in this space, a lot of times people are like, oh, I have this much in receivables. And it's like, but are those collectible? So you should value against it, because it might not be. You have your assets, then you have your liabilities, your payables, any debt, things like that. So your balance sheet is a picture in time of those things as one moment. Your P&L or profit or loss statement, which is another statement, that is generally for the year of your operation. So for most companies, it's a calendar year. And so that'll be all of your revenue, cost of goods sold, and expenses over the course of the year. And then it also, then you have come to income from operations, then you have other income, then you would also have taxes to come to your net income. One of the challenges in this industry with 280E, most companies, and it's not this simple as Rachel, it's not like you're taxed on your net income. There's, book to tax differences. But in this industry, it's almost like your gross profit, which is your sales minus your cost of goods sold, because all you can deduct is technically cost of goods sold. Then you would have your statement of equity, which might show your stock and your different equity transactions movement during the year, whether you issued more stock or when you close out your last year income, that becomes retained earnings. So if you made $100,000 in year one, that is basically becomes your retained earnings. And then you have what is called a statement of cash flow, which kind of shows the ins and outs of cash during the year. And generally we use what is called the indirect method, where you're basically taking the change. And those are the main statements that are presented. And then generally your financials will have notes that offer support for various numbers within there. And in a GAAP set of financials, really what the point is to give a universal language so that investors, bankers, and everyone, they understand the rules of that language, and then they can go in there and read the financials and understand and know how to interpret it. And then within my world, there's different levels of assurance we can offer. So again, assurance is a CPA giving an opinion on your financials. And in an audit, that's the highest level of assurance a company can get. And that's where a CPA will give reasonable assurance that your financials are materially stated. Then there's the next level down, which is a review. A reviewed financial differs from an audit because in an audit, you have to do risk assessment and you're doing a bunch of tested details. In a review, a CPA is basically doing inquiries and analytics, and they're given a report that gives limited assurance on those financials. In a compilation is a step down further. Basically, a CPA is doing a smell test, making sure there's no blatant issues. And then they're giving no assurance. And then the final is kind of preparation. That's new, where a CPA might just take it, put it on a report, and they're giving no assurance whatsoever, but they're helping you maybe present a financials, and at least it's coming from the CPA. All of these basically help users like Eric or others to look at it and be like, they're more confident if a third party came in and gave some sort of approval on your financials, right? If you hand someone to some financial to someone, it doesn't mean as much as if you hand them something that has a report from a CPA where they did some level of assurance, right? It gives more confidence to that lender or investor that someone's looked at these and made sure they followed the framework, and they're at least giving some level of assurance, whether it's limited or reasonable, that the numbers are materially stated.
Hey, Kevin, to that end, we hear so much about audited financials, right? How long does that process take?
It really depends.
What is
the hard thing is most companies come to me and it's like, someone asked me to get an audit or a review and now I'm here. And it's kind of like, okay, well, is your house in order, right? Are your numbers even audit ready? And most people, they're not, right? When they come asking, normally they've neglected their numbers in some way, and they just, hey, this allows me to grow or get to the next stage in my business. But it's like, there's a lot of work to make sure, are your numbers in accordance with GAAP? Can I even do an audit? Because as an auditor, I have to be independent. So I can't help you clean up your books and give you that stamp of validation. Right?
So if you look at it and their books are not audit ready, they have to go back to their accountant or CFO.
They either have to, they normally, when you look at it, if it's not ready, you're like, well, internally, you obviously don't have people capable of getting you there. So you already have an issue where it's like, you probably need to hire a stronger bench to make sure that your numbers are in accordance with GAAP. Because most third parties will request GAAP, right? That's the standard. And so it could be that you need to hire someone and you need to go through and scrub and get this all cleaned up and make sure that you're following GAAP guidelines for each component of your balance sheet and make sure you're in conformity of that. If they are in that, generally the process is we'll do a lot of, interim risk assessment. So there's kind of different touches in an audit. We have to go out and plan the audit, understand the risks, come up with an audit plan. Generally, let's say you're a 12/31, that'll normally happen like October, November, December, potentially. Then we'll come out after year end to do our formal audit procedures. But if you're like a cultivator or retail, we probably have to observe your inventory. So we might have to come out at 12/31 to do spot counts to validate things. Then we'll come out and do field work, where we're basically doing all of our test of details and helping prepare the financials, and then managers reviewing it, and then we're ready to issue. So the overall process can take several months if it's an audit. If it's a review, we don't have to do an inventory observation. You don't have to do a lot of the initial risk assessment. So that process can generally be done in a week or two. And that's if someone's numbers are ready, right? Oftentimes we see we'll come in there and there's a lot of journal entries we can assist with. We just have to make sure management is capable of taking responsibility for those entries and understand what those entries are. And so it is kind of a challenge. So I always think it's like, you don't want to just ask, all of a sudden someone's asking for an audit, I need an audit. Again, that's not strategic. Strategic is we want to grow. We understand to grow, we are going to need assurance, and we want to basically build our business to where we're getting that stuff. So that way, when you're asked, you're like, oh, here it is, right? How much more confident is that lender or that investor if they ask for it and you have it, versus like, well, now I got to figure out where to go and get this. You just delayed a bunch of stuff and you're not being proactive. Know that once we reschedule in some way and real dollars fly in and interstate lines open up, there's going to be assurance needed across the board for all these businesses to get further capital, to get lending arrangements. And if you want to sell, due diligence, generally there's 3 years of assurance required, where a company, if you're any serious buyer, would be like, show me the last 3 years of audited, reviewed, or financials.
So you allude to a great point there. We talked about it earlier. run your business today as if the current state is the future state, but prepare your business for tomorrow in terms of where you eventually want to be as it relates to systems and controls, financial audits, have your books in order, because like you said, if you want to sell, you're going to need 3 years of assurances. You can't do that overnight. That's a process.
No.
And if you get ready now, then by default, you're just ready then.
Well, when we do an audit initially, like if someone came to me as like, I want an audit for 12/31/2024, and they're a cultivator, I'd be like, it's impossible. Right. Because your inventory would need to be observed at the opening balances, right? When we do an audit, you have to understand opening balances and ending balances for the period. So normally if they come to me and like, I need a 12/31 audit, it's kind of like, I don't think you'll be able to roll back inventory. That's a heavy lift. I think what we should do is do an inventory observation and do some procedures now to set the table for an audit next year. And because otherwise it's like, you can't. And this is a business too with a lot of cash. So I would also have to count cash if it's material. And oftentimes there's a material amount of cash on hand in these businesses. So there's always things that in terms of like, if I couldn't count it or observe it, my hands are tied, and now we have to do other procedures, and generally those are incredibly costly. So the more you drag your feet, the more your numbers are messy, the cost of your audit is through the roof, right? If you're prepared and your numbers are good and you're ready and you do it, your audit is going to be significantly cheaper than if you're not audit ready.
Okay. So I'd love to bring this full circle with, first, Eric, I'd like you to talk about the types of financials that you look for. What are red flags when you see financials? Do you kick them back? And then I'd like to also talk about the types of loans that you have, the typical terms that you grant, and things like that. So go ahead, Eric.
Yeah. So, as mentioned earlier, we'll look for bank statements, P&L, balance sheet. We defined what those were earlier, so I don't need to go into that again. We look at your FICO. We do a background check on the ultimate beneficial owners. So, we look at the cap table, who's an owner. If they're an owner of a percentage over a certain threshold, we do a background check. Things that we look for are average daily bank balance. How many, overdrawn days are there? In the background check, do you have 15 credit cards outstanding? Do you have other claims against you? Again, this kind of goes back to just discipline generally. If you're not disciplined and run a good business in your daily life or in your current business, you can't be great in one area and sloppy in another. Those habits, those just aren't habits that happen that way. So we look for just good habits, right? And that comes good financial habits. That is in that if you have 4 unpaid cell phone bills and 4 different phone lines. Why do you have 4 different phone lines? And 18 different businesses and money's moving here and there and we can't make sense of it. Those are red flags. But generally, it's pretty straightforward. It's a background check, FICO, average daily bank balance, inflow and outflow of funds and where they're going, and it's pretty simple. And again, it happens very quickly, right? Once you turn your paperwork in, we're done in 24 hours, and the money can be in your account for anything under $1 million. Anything over, still just a few business days.
And you also require, I would assume, guarantees.
Yes, we do. We do, Kevin. Yeah, thanks for bringing that up. A personal guarantee, but we're not taking collateral. Again, we don't want your real estate or your product. I don't need a garage full of moldy product. So,
so security. There's really no security, and that's why you're really looking at financial health. Profitability, right. The balance sheet, things like that, and you're digging a little bit deeper into the earmarks and the red flags, that you'd want to see. So
yeah, absolutely, a behavior. And typically, when we get a client that uses a financial professional such as yourselves, that's a seamless process because it's all buttoned up. I mean, they upload the documents; it's done so quickly. It's quite remarkable because everything's in order. You just don't have another set of questions because you you receive everything that's been requested at the outset.
What happens if you get a set of financials and things just don't make sense? Do you kick it back to them, tell them to re-prepare it, then go get somebody like Kevin?
We try to be a good partner and a good steward. So usually it's a phone call. Like, can you help us understand what's going on here? Sometimes it makes sense. Sometimes it doesn't. But you try to be as collaborative as possible. And what we're trying to do is we're trying to get to a yes responsibly. But we're trying to get there, right? So the more we can understand, the better and smoother the process can be. But oftentimes that just ends up in a phone call. And can you help us? Can you walk us through what's going on here? Because our underwriters can't necessarily make sense of it.
And you have to make sure that who you're asking understands it. So often, like, my clients will come to me if they're applying for a loan with you or otherwise, or gathering investors, and their counsel or advisor has questions. I say, you know what, just send them to me, because oftentimes 100%. they may not be able to explain it very well, So, and if we know
absolutely,
the financial, yeah.
And by the way, the type of the explanation is what instills confidence in that something is being done correctly or incorrectly, right? So if you have somebody that doesn't really understand it, not that anything nefarious may be going on, but if they don't really understand it, then they can't really articulate why something's been done a particular way. But if they speak to you and you're like, oh, this is what we did. Okay, I got it, and then it makes sense, and it's a easier pill to swallow.
Yeah. That's why the financial literacy, that's why we went through some terms here too, because, often, we have founders, sometimes founders don't have advisors. They're trying to explain things themselves. And when it comes to this kind of situation, they're like, I know I just need money. So just really having somebody on your team who is financially literate, who is familiar with the financial statements, familiar with the general business operations, can help facilitate for you, Eric, and your team, So I think that's really key.
Okay.
So we're going to wrap up here, actually. So with that, any kind of closing remarks, advice for folks in the industry based on the years of veteran experience we have here in this room?
I would just say, again, be proactive. Know that operations, reporting, and compliance are the name of the game, and you have to make sure that you are addressing all three of those. Know that this industry is going to evolve, and those that focus on building a solid foundation for their business will be the ones that come out on top as this industry evolves. Those that are maybe not well capitalized, aren't committed to those three pillars. I would just say, the risks are great, that it's only a matter of time before you fizzle out in some way, shape, or form. So it really is one of those that you just have to be committed to. We're going to do this. We're going to do it right. We don't know everything. We're going to surround ourselves with the right people to make sure we can do that. Because again, you could be the best grower in the world, but the business can still fail if you're not committed to operations or to reporting or compliance. So I would just say be strategic and smart, and make decisions based on the numbers and logic, and surround yourself with the right people.
Awesome.
Yeah, I would echo that. You can't predict the future, right? And when we think about all the different variables, rescheduling, 280E, federal legalization, the movement of product across state lines, all those things that can impact your business. The one thing we can predict is if you don't do what Kevin says, you won't be around to experience any of that. And the landscape is already littered with what were deemed incredibly successful companies at one point in time that are no more. And if you don't do what Kevin says, you're likely to be, the next phase of that group of companies.
Yep. And I'd say definitely surround yourself with seasoned, resilient advisors that have been around, that have seen the ups and downs, the maturities, the declines, the upticks of the market. So, us advisors, I think some of us work all around the country. I see, for example, I was born and bred in the California cannabis industry, and I've moved my way out to the East Coast and then overseas to Europe. And you just see history repeating itself over and over and over again. But the advisors in this industry, you've got to be resilient. I've seen so many come and go. I see them come in and a year later they're gone, or the industry has declined and they're having a hard time hanging on. They also have a hard time hanging in with their clients as well. And so having a level head, bringing your right team around you. Don't be penny wise and pound foolish. Okay.
Yeah.
And I'm going to tell all business owners that, when I hear folks come in and they say, well, what are your rates? And they don't see the value. They don't see that on the back end, we save them millions and millions and millions of dollars for, say, $600 an hour or whatever the rate is, right? If you bring an advisor in that's seasoned and has been through the wars, has been through the ups and downs, don't be pound wise and penny foolish and go to your neighbor down the street to go get your tax returns done at H&R Block or your corner CPA who knows nothing about the industry. And if you have questions about a CFO or somebody that's in one of your companies and the internal controls don't seem to be in place, there's red flags popping up all over the place. Bring in, somebody like Kevin. It's worth it. It's going to save you millions of dollars on the back end. And same, if you're looking to grow your business and you have the right strategic team around you to make those decisions of the use of capital, don't be pound wise and penny foolish with your capital and your loans that you take. If you're strategic about this, you're going to make the right decisions. So I see that the people that don't want to make those investments and they're putting the right people and the right team around you, they're really not interested in a sustainable long-term business, period. So, you're going to have to wing it, and hopefully you're lucky. Some people have been lucky. I've seen it, and then there's other people that haven't been so lucky because they haven't surrounded themselves with the right advisors. And just watch for the fly-by-night people too. That's another thing I'm going to say. That's it. That's my soapbox right there.
A good advisor will tell you what you need to hear, not what you want to hear.
Exactly. No yes men. You can't have yes men around you.
Yeah.
That's a
like you got to hear the tough conversations are necessary.
Right.
And if the first question you ask is what are your rates, then it's the wrong question.
Yeah.
Because the experience is invaluable. You can't put a price on that. Exactly.
Okay, so Kevin, where do we find you online or otherwise? Telephone number. How do we get a hold of you if we need you?
Well, one through Rachel. She knows where to get me, but it's KHALLER at ppandco.com. So khaller at ppandco.com. My firm is PP & Co. Advisors or Petrinovich Pugh & Company. We've have several names. We were recently acquired by private equity. But like I said, Rachel can get in touch with me or through there. I'm happy to kind of connect and, hear what you have going on. And I even give, quick free guidance at times as well. If someone reaches out and has a basic question, just to kind of demonstrate that, I know what I'm doing and I can kind of help and give guidance. I'm here to help. I love this industry and have a lot of passion for it. And I want nothing more than it to succeed. And I know what all you operators have done to carry it this far. And so I'm grateful for that.
Thank you so much. And how about you, Kevin? Eric, how do we find you? I know how to find you too. So
yeah, it's funcanna.com or E. Kaufman. It's on the screen here, Kaufman, E. Kaufman at funcanna.com or on LinkedIn. And we'll be at MJ Biz in a prominent way. So would love to meet anybody in person. Love speaking to anybody and everybody and seeing how we could be collaborative, and whether that's, as Funcanna, or if I could just point you in the right direction, I'm happy to do that as well.
Great. And I'm Rachel Wright with 420 CPA. You can look at www.420cpa or verdantstrategies.com. And with that, I want to say thank you guys so much. I work with both you guys on a regular basis with my clients and things like that. So I love bringing people in that, help support the industry. And I really do appreciate your support and dedication to the industry. Thank you so much. And with that, I also want to say thank you to the Beard Bros, Beard Bros Media, Beard Bros Farm. We're all going to be hitting the road here soon. So just kind of keep an eye on what the Beard Bros are doing. We're going to be at NECAN coming up in Syracuse, New York. We're also going to be at MJ BizCon, like you said, we're going to have some cool things going on there. So watch the Beard Bros Media. I think we're going to have there's going to be some big parties. I can't disclose too much, but you just stay in touch. Okay. Just follow along. And Beard Bros is doing some really, really big things this year. And as well as, supporting those folks that have come before us and paid the penalty and are still paying the penalty. So the Edwin Rubis campaign here to support Edwin Rubis. I don't have all the dates right in front of me, but we have some very important dates coming up to help petition to get him out of prison, and hoping that he gets out. So, those of us that are actually making money out of the industry should also try to help support the industry as well, have a heart for it. So with that, thank you so much. And thanks, guys. I really appreciate you.
Thank you, Rachel.
Thank you, Rachel. And thank you, Beard Bros.
Bye.